What if the biggest wealth building opportunity of this decade isn't something you'll see trending on social media? While millions of people are chasing the next hot stock, the next cryptocurrency, or whatever asset is making headlines this week, wealthy investors are often thinking about something completely different. What will still be valuable when the world looks completely different in 2030? Because real wealth isn't usually built by finding the asset everyone is talking about. It's built by owning assets that become more useful, more scarce, or more productive over time. And today, we're breaking down 7 assets that could become increasingly important before 2030. Some are obvious, some are surprisingly boring, and one of them could completely change how you think about building wealth. But remember, this isn't a prediction that any asset must go up. These are ideas to research, not financial advice. Let's start with number 7. Asset number 7, productive land. When people hear land, they often imagine empty farmland sitting somewhere in the middle of nowhere. But wealthy investors may look at land differently. They look at scarcity. You can create more houses. You can build more factories. You can print more money. But you can't manufacture more physical land in a desirable location. And that's where the investment thesis gets interesting. Land near growing cities, transportation corridors, logistics hubs, energy infrastructure, or expanding communities can become increasingly valuable because development needs physical space. Think about the simple equation. Population growth plus limited supply plus useful location equals potential value. Of course, not every piece of land is valuable. Taxes, zoning, water access, insurance, financing, and local economic conditions can completely change the picture. That's why wealthy investors aren't simply asking, how much land can I buy? They're asking, what problem could this land solve 10 years from now? That shift in thinking is important. Asset number 6, infrastructure and infrastructure-linked investments. Here's an asset category most everyday investors rarely think about. Infrastructure. Power grids. Data centers. Transmission systems. Ports. Railways. Utilities. Telecommunications infrastructure. Why could this matter before 2030? Because America is becoming increasingly dependent on electricity and digital infrastructure. Artificial intelligence needs enormous computing capacity. Data centers need power. Electric vehicles need charging infrastructure. Factories need reliable electricity. And businesses increasingly depend on digital networks. The interesting part is that infrastructure isn't just about technology. It's about the physical systems underneath technology. Imagine the internet as a city. Everyone talks about the skyscrapers, but someone still has to build the roads, electricity systems, pipes, and transportation networks underneath them. Infrastructure can potentially generate cash flows through long-term contracts, fees, or regulated structures. For individual investors, gaining exposure may come through publicly traded infrastructure companies, utilities, REITs, or specialized funds. The key isn't buying whatever sounds futuristic. It's identifying the bottlenecks the future economy can't operate without. Asset number 5, gold. Now let's talk about an asset that has survived thousands of years of economic experiments. Gold. Gold doesn't generate earnings like a company. It doesn't pay you rent like an apartment. So why do investors still care about it? Because gold plays a completely different role. It can function as a store of value and portfolio diversifier, especially during periods of monetary or geopolitical uncertainty. Think of it as financial insurance. You don't buy insurance because you expect your house to burn down tomorrow. You buy it because you don't know what tomorrow will bring. The same idea can apply to gold. But there's an important distinction. Gold shouldn't automatically become the center of your portfolio. It can be volatile. It produces no cash flow, and its price can spend long periods moving sideways. The bigger lesson is this. Wealthy investors often don't ask, what's the highest returning asset? They ask, what happens to my wealth if my assumptions are wrong? That's a much more sophisticated question. Real estate with real cash flow. Real estate isn't new, but the way you think about it can be. A common mistake is believing that owning any property automatically means you're building wealth. It doesn't. A property can become a financial burden if the numbers don't work. Wealth-focused investors tend to pay attention to cash flow, location, demand, financing, maintenance, taxes, and long-term economics. And there are many ways to gain exposure. Rental properties, commercial real estate, industrial properties, data center-related real estate, or publicly traded REITs. Here's the engineering-style way to think about it. A property is basically a machine. You put capital into the machine produces rent. You subtract operating costs, taxes, maintenance, financing, and vacancies. What's left is the economic output. If the machine consistently produces more value than it consumes, you've got something interesting. If it constantly requires more money from you, the fact that it's called real estate doesn't magically make it a good investment. Don't buy the building. Understand the economics.
Asset number 3, businesses and equity in productive companies. This might be the most important category on the entire list. Ownership in productive businesses. Because billionaires don't become billionaires by simply holding cash. They usually own pieces of businesses. When you own shares of a strong public company, you're not just holding a ticker symbol. You're owning a small piece of an economic machine. That company has employees, intellectual property, customers, distribution, technology, brand power, and potentially the ability to generate profits for decades. Before 2030, the businesses that may matter most could be connected to major structural trends: AI, cybersecurity, healthcare, energy, automation, semiconductors, infrastructure. But here's where investors often make a huge mistake. They see a great industry and immediately buy the most popular company in it. That's backwards. A great industry doesn't guarantee a great investment. You still have to consider valuation, competition, debt, margins, management, and future growth. The real question isn't, what company will become famous? It's, what company can continue producing valuable economic output while the world changes around it?
Asset number 2, intellectual property and digital assets that produce cash flow. Now we're entering territory most people completely ignore. Intellectual property, software, licensing rights, patents, digital products, media libraries, specialized data, and businesses built around recurring digital revenue. Why is this interesting? Because digital assets can sometimes scale differently from physical assets. A physical factory may require another building, more equipment, and more employees to dramatically increase production. Software can potentially serve millions of additional customers without increasing physical infrastructure at the same rate. That's why intellectual property can be incredibly powerful. But there's a catch. Not every digital asset is valuable. A website isn't automatically an asset. A social media account isn't automatically an asset. A piece of software isn't automatically valuable. The real question is, does it solve a problem people are willing to pay for? That's the difference between owning digital noise and owning digital intellectual property. And as AI accelerates content creation and automation, scarce expertise, proprietary systems, valuable data, and defensible intellectual property could become even more important.
And here's the asset most people completely underestimate. You. Your skills, your knowledge, your ability to create value. Think about it. Stocks can crash. Real estate can fall. Currencies can lose purchasing power. But if you have a highly valuable skill, you can potentially take that skill to another company, another industry, another city, or even another country. That's human capital.
If this video helped you, hit the like button, share it with someone who's making 6 figures, and subscribe for more practical money and investing tips. Thanks for watching, and I'll see you in the next one.